We just saw what has to be one of the most high-stakes 24-hour cycles for the entire digital asset market.
Absolutely. I mean, it had everything. Macro shocks, a huge legal precedent, and some just massive institutional moves.
The volatility was definitely there,
Hmm.
but the way the market responded, it felt, I don't know, surprisingly mature.
It was, truly. If you were watching the charts yesterday, you basically saw a live stress test. And the main finding, the thing that really stands out from our data, is just undeniable resilience.
Right.
Despite getting what everyone first thought were these, super hawkish signals from the Fed, Bitcoin didn't even flinch. It staged this solid recovery, got back above $92,000.
And it wasn't the usual retail frenzy driving it.
Not at all. This was underpinned by some serious, accelerating institutional buy-in, some major legal clarity, and just the growing maturity of the infrastructure.
Okay, so that's our mission today. We need to figure out why the market held so firm. We're going to get into the Fed's conflicting signals, this whole hawkish cut paradox. And then we have to examine how closing the book on the Do Kwon fraud era really sets up a new legal blueprint for the whole industry.
Yeah, and finally, we have to connect the dots. How these titans of traditional finance are now betting not just on the price of Bitcoin, but on the physical nuts and bolts infrastructure that powers the whole thing.
All right, let's jump right into that macro fight then. Let's start with the immediate price action. After that initial dip yesterday, the market really bared its teeth.
It did.
We're trading right now near, what, $92,114, something like that, posting a pretty solid 1.87% gain over the last 24 hours.
Which completely defied that initial bearish mood.
Completely.
That first drop was a classic knee-jerk reaction. But the technical defense that came after that was professional money at work. We saw this really robust structure form, especially around that $90,000 psychological level.
And analysts are pointing to a new formation, right?
Yeah, a minor golden cross on the shorter time frames. Specifically, you're seeing the 8-day moving average cross up and over the 30-day.
So for anyone just catching up, a golden cross, even a small one like that, is generally seen as a short-term bullish sign. It sort of suggests that the recent momentum is finally starting to break through that near-term resistance.
Exactly right. And that pattern, it established a very clear, very robust support zone. Call it between $90,500 and $91,300.
And institutional players were defending that hard.
Aggressively. So now, the next major hurdle, the big test we're all watching, remains at $94,700. A sustained break above that would signal a full reversal.
Okay, so the technicals make sense. But the fundamental question is still there. Why did the price bounce back so hard when the news from the Fed felt, well, bearish? Let's unpack this hawkish cut thing, because it's confusing.
It is, and this is where you really have to understand the market mechanics. So the Fed cut rates by 25 basis points. On the surface, that's good for risk assets.
Right, cheaper money.
But the sell-off, that was fueled entirely by the dot plot. The Fed members' own projections. They suggested they only see one single rate cut in all of 2026.
Which is way less than what the market was expecting.
Way less. So the market was selling the future, not the present.
Okay.
But here's the pivot. This is the crucial part. The market very quickly looked past the talk and focused on the immediate mechanical injection of liquidity.
The actual money printer.
Pretty much. Starting today, December 12th, the Fed is buying $40 billion in Treasury bills every single month.
$40 billion.
Yeah.
I mean, that's basically a mini version of quantitative easing of QE.
It is. And if you look at the historical data, expansions of the Fed's balance sheet have always correlated way more strongly with Bitcoin's price than the interest rate itself.
So watch what they do, not what they say.
That's the playbook. That $40 billion a month is just overriding all the tough talk. It signals that no matter what they say about the future, they are structurally committed to keeping the system full of cash right now.
That distinction is so key. And it perfectly frames our next topic, because you can't absorb that much capital if the market thinks the foundational risks are still there. Which brings us right to the end of the K1 era.
This is arguably the most significant structural development of the week. Do Kwon, the Terraform Labs co-founder, was sentenced to 15 years in a U.S. federal prison for fraud.
And this is so much more than just payback for 2022.
Oh, absolutely. This establishes a comprehensive legal framework. It creates a precedent for what liability looks like for algorithmic stablecoins in the U.S.
So what were the specific details from the prosecution that are so important here? What sets that precedent?
Well, the court really zeroed in on two main pillars of active deception. First, that Kwon falsified his adoption data. He was telling investors that the Terra blockchain was being used by this Korean payments app, Chai, when those claims were basically false.
Okay, so that's straight up fraud. What was the second thing?
Well, the second, and this is crucial for future regulation, is that he was found guilty of secretly manipulating the UST peg back in 2021. He was using Jump Trading's capital to prop it up.
While telling everyone it was a self-healing, decentralized algorithm.
Exactly. So the core fraud wasn't that the math failed, it was the misrepresentation, claiming decentralization while secretly pulling centralized levers. For any big institution looking to allocate capital, closing this chapter is a huge psychological step. It's a signal that the Wild West days are over.
And we're seeing a similar move toward, let's say, domestic maturity on the regulatory side, too.
We are. The CFTC formally withdrew its 2020 actual delivery guidance this week. Now, this sounds obscure, I know, but the implications for market structure are massive.
I remember that guidance. It basically made it impossible for regulated U.S. firms to handle custody for leveraged retail trading, right? It pushed all that business offshore.
Precisely. The old guidance created huge operational headaches. By scrapping it, the CFTC is basically saying, we want this leveraged derivatives market back here in the U.S. where we can actually oversee it.
But doesn't that just favor the big guys, the ones who can afford the huge compliance costs of operating onshore? Is it really liberalization, or is it more like domestication?
That's the critical tension, you're right. It definitely favors firms that can handle that compliance load, which, just accelerates institutionalization. The immediate winner here is Bitnomial.
Right. They announced they're launching a new venue.
The first federally regulated venue for physically settled, leveraged digital asset products in the U.S. I mean, that is a huge step forward for creating deep, regulated derivatives markets here at home.
And that whole process of maturation brings us to this friction between crypto-native companies and legacy finance. I'm talking about MicroStrategy, MSTR, and its very public fight with MSCI over index inclusion.
It's fascinating because it highlights just how awkwardly the old guard is handling pure crypto exposure.
And the scale is just staggering. MSTR's Bitcoin holdings are over $60 billion now, right? That's almost the entire value of the company.
It is. And MSCI, which governs these huge global stock indices, is now reviewing its rules. They're thinking about excluding any company where digital assets make up more than half of its total assets.
If MSTR gets kicked out of a major index, that would force all the passive funds, all the ETFs that track it,
to sell. Trillions of dollars track these indexes.
It would be a catastrophic forced selling event. The premium that MSTR stock commands over its actual Bitcoin holdings would just collapse overnight.
It would. And the debate really gets to the heart of an identity crisis. Is MSTR a software company that holds some Bitcoin, or is it basically a regulated, publicly traded Bitcoin fund? The answer will set a huge precedent.
This whole MSTR classification struggle perfectly sets up our next section on institutional infrastructure. Because if you're going to hold $60 billion of anything, you need audit-grade, rock-solid infrastructure.
Which is exactly why the move by Coinbase this week is so significant.
What did they do?
They officially selected Chainlink's Cross-Chain Interoperability Protocol, that's CCIP, as the exclusive bridge solution for their entire $7 billion suite of wrapped assets. Your CBBTC, CBETH, all of it.
Wow, exclusive. We all know cross-chain bridges have been the ecosystem's Achilles heel. I think the hack total is over $2 billion now. So why outsource to CCIP? What makes it better?
It all comes down to liability and auditability. Coinbase needs a standardized third-party solution that big banks and custodians can look at and trust. And CCIP has this one crucial feature, the risk management network.
Okay, tell me more about that.
It's basically a secondary independent layer of nodes that does nothing but watch the transactions going across the bridge. It's looking for anomalies.
Like someone trying to mint an infinite amount of wrapped Bitcoin out of thin air?
Exactly that. And if it sees something suspicious, it can trigger an emergency halt on the bridge. This dual-layer security, it takes bridges from being a risky experiment to being a standardized, almost banking-grade piece of infrastructure. And that is exactly what big finance demands.
Speaking of big finance, this is where the story gets really interesting. We saw a filing from Citadel Securities Group, one of the biggest market makers on the planet. They disclosed a 5.5% passive stake in the Bitcoin miner Core Scientific. They've done similar things with TerraWolf. Why are these Wall Street titans suddenly buying up crypto mining stocks?
I think if you connect the dots here, this is a much deeper play. This isn't just about the price of Bitcoin. This is an arbitrage play on energy infrastructure.
On energy.
Yes. Bitcoin miners own something that is critically undervalued right now. Massive energized power hookups and high-density cooled data centers. These are the exact physical assets that are desperately needed for the AI boom.
So Citadel isn't buying the hash rate, they're buying the power shell and the cooling systems?
Exactly. The hash price, what miners earn, is critically low right now. Around $38 a day per petahash. Their margins are thin. Citadel is betting these companies will pivot from low multiple crypto mining to providing high multiple high performance computing services to AI clients. They're buying undervalued options on the future of computing.
That completely reframes how you should look at the mining sector. It's not just a commodity business, it's a high-growth infrastructure play.
And while that's happening, the capital just keeps pouring in. We had a huge liquidity event just yesterday. Tether and Circle minted a combined $1.5 billion in fresh stablecoins.
That's a lot of dry powder hitting the on-ramps.
It's a massive buy signal. You had $1 billion in USDT on Ethereum, which signals institutional positioning. But crucially, $500 million of that in USDC was minted on Solana. Relative to the size of Solana's ecosystem, that is a huge injection of cash. It suggests smart money is getting ready to buy.
Okay, let's pivot now to global adoption and the absolutely critical security landscape. On the government front, we saw a huge policy reversal in Pakistan.
A complete U-turn. The Pakistan Virtual Assets Regulatory Authority, PVRA, granted no objection certificates to Binance and HTX.
So they're going from banning crypto to actively legitimizing global exchanges.
Yes, and this is for a market of 240 million people. It opens the door to formal capital flows in a massive, young, and historically crypto-hungry population.
And meanwhile, El Salvador keeps using its Bitcoin First brand to punch above its weight.
They're playing the long game. They partnered with Elon Musk's xAI to roll out the Grok AI system across 5,000 public schools. They're leveraging their reputation as a tech-forward nation to land these huge next-gen tech partnerships.
And you're even seeing it in European fintech. Klarna partnered with Privy to build a simplified crypto wallet right into their app.
That's mainstream, frictionless onboarding for millions of everyday shoppers. It's huge.
Okay, before we wrap up, we have to issue a really critical safety warning that everyone listening needs to hear.
Yes, this is serious. Ledger's Donjon security team put out a major alert about a severe hot wallet vulnerability. It's in the MediaTek Dimensity 7300 chips,
Which are found in millions of mid-range Android phones all over the world.
Right. And this isn't just a simple software bug. The threat is what's called a side channel attack.
So this isn't someone hacking you over the internet.
No, this requires physical access to the device. An attacker can use something like electromagnetic fault injection to disrupt the chip's security. This lets them bypass the checks and literally dump the device's memory.
Which means they can just extract the private keys or the PINs from a software wallet, like MetaMask or Trust Wallet, that's running on the phone.
That's the threat. It just reinforces a fundamental truth. Your smartphone is not a secure vault. If an attacker gets physical access, your hot wallet is incredibly vulnerable to these kinds of sophisticated attacks.
It really hammers home the need for dedicated hardware wallets, for cold storage.
Precisely. Those devices are built from the ground up to resist these physical attacks.
Yeah.
You just can't trust a general-purpose computer to secure your life savings.
And on that topic of ecosystem safety, we are seeing some solutions emerge at the network level too.
Right. On Solana, Jupiter launched something called Jupiter VRFD, which stands for Verified. It's a new cryptographic verification layer.
To combat all the fake imposter tokens.
Exactly. Right now, you search for a token and you get a dozen fakes. With VRFD, the real project team can cryptographically sign their token's metadata, so it moves safety away from some centralized list and toward a decentralized proof model. It's like a digital stamp of authenticity.
And finally, we saw a regulatory body validate a huge security failure. The UK fined LastPass.
A £1.2 million fine for that 2022 breach. And security researchers are now officially attributing over $10 million in mysterious crypto drains this year directly to that breach.
So the connection is confirmed. Attackers cracked the vaults from 2022, found the seed phrases people had stored.
And then just waited years to drain the accounts. It's a critical lesson. Never, ever store your seed phrase in a cloud-synced password manager. It is a single point of catastrophic failure.
This has been an incredibly dense 24 hours. When you pull back, the crucial narrative seems to be that, yes, the market defended $92,000 in the short term, but the long-term story is this accelerating institutional maturity.
I think so.
You have legal risk getting clarified with the K-1 sentence. You have infrastructure being standardized by Chainlink. You have huge capital flows from Citadel and those stablecoin mints. The smart money is choosing to build and comply.
Absolutely. The foundational risk is being chipped away by regulation and better infrastructure, and that's paving the way for the next wave of capital. And I think this raises a really important question for you to think about.
Go on.
As these traditional titans like Citadel start to view Bitcoin miners as core energy and AI infrastructure, and they see companies like MicroStrategy as giant regulated crypto treasuries, how long can legacy indices like MSCI really afford to treat them as weird outliers?
The definition of a tech stock is changing right in front of us.
It's changing fast. And this classification battle, where these companies belong, that will ultimately determine where trillions of dollars in passive capital is forced to flow next.